So I love lending against Bitcoin, right? And
it's funny. Everyone who lends against it loves it for the pristine collateral that it provides.
100%. So I've been lending against people's properties since 2018, and generally we do a very good job at that. But there are loans we've lost money on. I've never lost money lending against Bitcoin. Mm-hmm. And what we're trying to do right now is a structure that I believe we can bring to market where if the borrower on a 12-month loan pays, something like a 1.5% fee up front, at a 50 LTV, we will immunize them from any liquidation, right? So we will never do a capital call on you.
And how do you do that? What's going on, guys? Today we got a great conversation with Mike Cagney. He's the founder and executive chairman of Figure. Figure just went public, and they've got a great business that is modernizing all of the infrastructure and finance. They've got everything from HELOCs to Bitcoin-backed loans and many other credit products. But the secret to this business is they've built it on top of brand new infrastructure that is leveraging blockchain and decentralization. Mike is somebody who's been innovating in financial markets for a very long time. He's got very unique views, and this business is something that I think a lot of people are excited about. I've been an investor for a long time, and Mike's here to explain to us not only what's happening with all the digital infrastructure, but also things like stablecoin, Bitcoin-backed loans, and many other things. Here's my latest conversation with Mike Cagney. All right, Mike, I thought a great place to start the conversation. You just took Figure public. That's obviously a big milestone for any company. You've been at this for a while now. You've built a number of great products inside this business. Talk a little bit about going public, what that experience was like, and why you think it's better for the business.
Sure. I mean, I think there were a couple of drivers for why we decided to go public. I think one, I fundamentally believe, just like we have this Mag 7 and Web 2.0, we're going to have that in Web 3.0. I think the opportunity set is so huge, not just from disrupting existing businesses. Certainly people talk about changing the way we trade stock. The reality is the NASDAQ works okay right now. It's, there's opportunity there, but it's not enormous. But the greenfield opportunities are huge. And so, we felt it was a great opportunity to be able to go to market and tell the narrative as to what it means to be a public company on public blockchain and why it matters. So that was important. The second driver for it was, back when I was at SoFi, I raised $1 billion from SoftBank. It was the largest private capital raise anyone had ever done. And I always talk about the story about, I didn't want the billion, I wanted $200 million. And Masa was like, if you don't take the billion, I'll give it to your competitor. And I was like, all right, shucks, I'll take the billion. It was a huge advantage for us from a competitive standpoint. And it was really the catalyst for them starting the Vision Fund. And it just allowed us to use our balance sheet in a way that was still prudent. We were still running profitably, but what we were doing was, effectively able to take risks that none of our competitors could. Mm-hmm. And so I saw the same situation here, the same dollars on the table, and said, look, let's take those off the table and leverage them.
Now, when you went through the IPO process, there is this allocation conversation that you have with the bankers. Depending on how much cachet you have, depends on how much influence you get in that allocation conversation. You have a lot of cachet. And the company gave nearly 20% of the IPO allocations to retail investors. Talk a little about that decision.
Yeah, there's a lot of conflict around that, and a lot of different interests that folks have. I was very adamant that we had broad retail representation in what we were doing. And ultimately, one of the most powerful things I see about blockchain is it's an incredible democratization force and leveling the playing field. I think DeFi, the ability for anyone with capital to lend anyone who needs capital, irrespective of whether you're a large lender, small lender, large borrower, small borrower, those are really the underpinnings of why blockchain matters. And I think why it is so transformative. And so having retail participation was very important to us. And we got a lot of pushback on that. A lot of concern about retail doesn't stay in, et cetera, et cetera. I mean, geez, I can show you.
That's kind of a crazy argument against retail, right?
Yeah, I can show you the last couple of IPOs where, the big institutions, the long-term capital holders flipped. And so, for me, it was around, I wanted a shareholder base that was going to buy into the vision of what we're trying to do. What we do right now, and obviously Trump tweeted out today he wants to change quarterly reportings to semi-annual reportings. I'm not sure 3 months is changing your ability to be long-term perspective, but directionally it's right. But one of the things I always point out to folks is I'm like, look, I'm very proud of our team and the profitability they've been able to generate and the business they've been able to build. But it's almost immaterial when you look at what the real opportunity is. I mean, we're talking about a wholesale replacement of almost everything in the capital markets with this technology. It's disintermediating trillions of dollars of market capitalization. And I want people to buy into that long-term vision to be part of it and grow there with us.
Now, as you've started to do this, you've both gone after the infrastructure of the financial system, but you've also built some of what I'll consider like more consumer-facing products on top of that new infrastructure. Let's talk about what you're changing on the infrastructure side first, and then we can show kind of the applications. Like, where did you see the opportunity to go and just essentially improve the way that finance worked?
Yeah. So look, the very first thing that we felt, we view three value props in blockchain. There's a transactional benefit, a liquidity benefit, and a financing benefit. And they're all rooted on this idea of true native digital securities or native digital assets, right? So not, I kind of bristle at taking a DTCC security and putting it on blockchain because that isn't the actual security and it changes the paradigm of trading and borrowing and so forth. But when you have a true native digital security, you can really do some incredible stuff. And so, when we started Figure, we went out and pitched a bunch of banks this idea of originating, aggregating, securitizing loans on blockchain, saving 85 basis points of cost. And uniformly, every bank was like, this is great. We love it. We'd like to be the 10th bank to do this. And so there was no appetite to move early. So we stood up a direct-to-consumer lender. And it wasn't, like coming out of SoFi, I wasn't, I want to build another direct-to-consumer lender. It was just an artifact of something we needed to do to be first mover into the blockchain. And
is it fair to say that you essentially said, hey, we built this thing, we need people to come and be the consumer of it, but nobody wants to be the first consumer, so we'll just be the first consumer to prove that it works?
Yeah. And that's been a process or a formula that we followed multiple times with Figure. And I tend to follow that when we do the stock issuance on blockchain, even when that happens, which hopefully it will. And so what we were able to do is actually demonstrate not 85 basis points of value, but over 100 basis points of value through reduction of audit and QC and third-party review expenses. More importantly, what we started doing last year, so we went on this evolution. We started as a direct-to-consumer originator. So we would acquire customers, we would use our balance sheet, we would then securitize those loans. Then we became business to consumers. We have over 170 third parties that use our platform, including 10 of the top 20 mortgage companies, but they would still use us to intermediate between them and the capital markets. Last year, we started to disintermediate ourselves and allow them to access capital directly in a blockchain marketplace. And over 40% of our Q2 volume went through that marketplace. And what we saw was last year's EBITDA margin at 31%, go to 37 in Q1 and 47 in Q2. As we were able to get more and more of that volume flowing directly through the marketplace, which is ultimately what we are, a marketplace operator. Mm-hmm. So the infrastructure is very well in place right now. And I believe that value proposition between the transactional efficiencies and liquidity are extensible into other asset classes. What we're trying to show right now is the value of DeFi, sort of the third leg in the stool from my perspective, which is the financing side. And, I'd always been very jealous when I started to figure out, I was looking at Aave and what Stani did. And I'm like, I don't understand why you can borrow against your Ethereum at 6.5% on Aave, and I'm paying Goldman 7.5%, right? And I would beat up my capital markets folks and they're like, we don't understand. I'm like, all right, well, let's stand up a DeFi platform. And we stood up this thing called Democratized Prime. And we initially seeded it out just using it on our exchange. We run a relatively small crypto exchange, but it's very strategic for us. And we were able to demonstrate that, in fact, I could borrow Bitcoin or borrow against my Bitcoin, buy it on margin, and pay less than I would if I was borrowing from Cantor, right? And so what we started to do is bring loans over and demonstrate that, and that has proven to be consistent with what we thought it would be. And there's a huge opportunity in terms of building out that third leg of the stool, which is the DeFi side. And that's really the infrastructure. The go-to-market on the consumer side, we started with HELOC. We do first lien mortgage now. We'll expand into almost every credit category, but we'll also be moving into things like equity and ultimately commodity and currencies as well, because I firmly believe that the value prop's extensible to any asset class.
What's funny is you became the first consumer of the infrastructure change that you made. I think you built the third largest HELOC originator in the country, or top 5 for sure.
Certainly the largest non-bank originator. Yeah, one of the biggest
by accident.
Yeah, it wasn't necessarily the model, and now it's becoming a very large first lien originator as well. But it's one of those things that just dropped out, right? Yeah. And it ended up like I believe that if you look at what we've done versus, say Intercontinental Exchange, because I think they have aspirations to build the same kind of mortgage marketplace, or a lot of the RWA platforms out there, right? What's different about us is we control production, we control takeout, right? It's rare to get a combination of DNA of someone that knows how to originate assets and knows the capital markets, understands blockchain and decentralization, and can intersect those two in a way that makes commercial sense. And I think that's what we've done.
Explain a little bit more when you say you control the production and you control the takeout, what that means.
So we can originate the assets ourselves. So if you don't want to originate them, we'll originate them, right? So in the beginning, that's what we were. We're now a very small part of the overall ecosystem of asset origination within our platform. And I'd expect we're going to get even smaller over time as more and more third parties come in and leverage that technology. But when we do a new product, let's say we move into auto or unsecured consumer or student loan, we can be the first one to originate there, demonstrate it, and then have fast follow behind it. And hopefully the half-life of that fast follow shrinks on every asset. So that's the production side. The takeout is we can use a balance sheet, aggregate, and securitize. We have our own shelf. We have one of the best shelves, I think, in the programmatic ABS space that's out there. So, obviously, over time, what we really wanted people to do was use that marketplace and sell directly to the capital markets. But in the beginning, we could be the takeout and we could provide that outlet.
And as you see this go through, you've started with credit. You mentioned equity. What do you guys plan to do there?
So, there's a lot of discussion around tokenization of stock. And I always kind of bristle at the word tokenization because to me, it means taking something that doesn't live on blockchain and trying to represent it on blockchain. And I've got a long history of going against IBM's ridiculous, we're using blockchain to track your strawberries because the blockchain doesn't have eyes and can't actually see your strawberries move. It's not a great application for the technology. And, other people would argue with me and say, this is what the role of oracles are. To me, in Oracle, you have to trust, and I don't want to trust anything. And so, in the structure of equities, if you create a native digital equity on blockchain, so not a DTCC security where it's an IOU, but the security itself is on blockchain, it affords all the superpowers you get from blockchain in terms of I can transact bilaterally with you and you've transacted to the asset. I can lend against it and I know have perfection of the asset. I know it's not double pledged. I know it's not sitting somewhere else. And so that introduces some pretty interesting efficiencies. So there's certainly, think about the three efficiencies of blockchain. There's some transactional benefit of that. It's cheaper for the transfer agent to track it, when it's on chain. There could be some liquidity benefit in the 24/7 trading. As you know, I was trying to bid to lift FTX out of bankruptcy, and I saw what the equity perp market looked like. It wasn't like it was on fire with people wanting to trade equities 24/7. So there's some benefit there, but it's not necessarily significant. But what's really powerful is bringing it onto DeFi, right? Where now I have that equity and I can use it to borrow to buy Bitcoin or vice versa. I use Bitcoin to buy the equity. I do it seamless. I control my stock loan, right? So today, when you're an asset manager, you lend your stock out for borrow and it goes on special, meaning it goes from 5% to 40%. Your prime broker is taking almost all of that, right? Or taking a huge cut of that. And so if you control it, if you custody that stock and you control the loan, you get all the economic. Right? You decide what you want to lend it at and when you want to pull it back. That I think is super powerful. And so what I'd like to be able to do is do a blockchain native public equity security. So we already have the first, I think, public fixed income security native to chain with yields, which is our stablecoin. But I'd like to do the public equity. I'd like to be able to have it convertible at the Treasury to the national market exchange securities. So the two don't go out of whack. And I think if I'm on the buy side, why wouldn't I buy the blockchain version where I can control the borrow and use it as collateral versus the NMS security, right? And then obviously you don't have the capital pledges to DTCC. I think DTCC sits on $50 billion of street capital on any given day. Like you can liberate all that out, right? So there's some real significant benefits that come out of this.
Today's episode is brought to you by Xapo Bank, where eligible members can unlock the power of Bitcoin without selling it. Need cash fast? With Xapo Bank's Bitcoin-backed loans, you can access 40% of your Bitcoin's value, borrowing as much as $1 million for a full year with low interest rates, zero fees, and no early repayment fees either. Now here's the best part. You keep your Bitcoin, meaning you get to watch your holdings grow as the price of Bitcoin increases. Whether you're looking to buy a house, fund your child's education, or seize an exciting investment opportunity, these loans give you the flexibility to access cash without selling your Bitcoin. Unlike traditional loans, Xapo Bank's Bitcoin-backed loans have no minimum repayments, no early repayment penalties, and the flexibility to settle your loan in USD or Bitcoin whenever it suits you. It's liquidity entirely on your terms. Zappo understands the unique needs of Bitcoin holders. That's why they have developed a product designed specifically for you. With over a decade of experience in the Bitcoin space, Zappo Bank has been a trusted partner for those looking to make the most of their Bitcoin while keeping it safe. Your Bitcoin stays safe in your vault, untouched, never lent out, and secured in a global network of military-grade bunkers with cutting-edge security technology. Head to zappobank.com/pomp to learn more. That's XAPOBANK.com/pomp. Go check them out at zappobank.com/pomp today. So the idea would be, let's just call it the traditional stock, like share, the equity, and there would be a blockchain version, but it is not taking the traditional stock share and tokenizing it. Instead, it is its own different native thing that is issued by the company. And then therefore, a holder of the blockchain-based one could swap into the traditional one if they want to, or vice versa. So there's like this interchangeability between the two. But it's really the company is saying, look, I don't want to give out my stock, have you go like, a lot of these guys seem to be like putting it in SPV or something and then like tokenizing the shares in the SPV so you don't really actually own the equity. It's kind of a little weird, right?
Well, and that's the problem is again, you have to trust that the SPV is there. You have to trust the assets are in the SPV. How do you have transparency to that on blockchain? You don't. You're relying on someone's attestation. Those assets could be sold. They could be double pledged. There's all kinds of problems that you bring and introduce into that. And you know, we lived through a lot of that through the FTX debacle and some of the other situations that we've had. And I think we came out of that smarter around really staying steadfast to the principles of blockchain. And that's around decentralization, transparency, and perfection of asset.
Forget kind of how we get to the point, but let's just say that in the future, I have an app on my phone or a wallet, and I've got digital equity, I've got digital fixed income, I've got kind of these digital versions of all these assets that currently exist. Do you see a world where I actually buy stuff with the equity rather than a currency?
Yeah, of course. And so I have a very good friend that wrote a paper on this many years ago called NEV money and NAV money, right? Net asset value money. And it introduces a medium where you now have that flexibility of exchange. Mm-hmm. And, you know, I think this is one of the big things about the Genius Act is what we've not been able to do with stablecoin historically was use it for purchases. And that's because US payment infrastructure has a massive monopoly. And in my mind, the only way that monopoly was going to get broken is if Chase leaned in and said, we're going to build our own rail. And I think they will. I think, you know, they'll use JP Coin as a catalyst to do this. But when you have a mechanism then where I have a single wallet that I can hold my cash, I can earn some rewards or return on it. And it's debatable about how that return happens under Genius, but I have some premise like that. But I can buy coffee, Bitcoin, Tesla stock, and pay bills all out of the same medium. I don't know why I need a bank account in that situation, right? That also opens up the opportunity for the transfer of other medium, like using Bitcoin for transactional purposes, right? Things that you can do with relatively low friction. But I think that second order effect about why would I have a bank account, that's profound. And I don't think people are focused on that enough. You know, like when the Treasury is talking about $2 trillion moving into stablecoin on the back of the Genius Act, well, where's the money come from, right? It's not like it was just sitting there idle and not being used. It was at banks. It was in bank deposits. And, you know, in 22 and 23, when the Fed started to tighten, I know it's interesting because we're talking about the Fed loosening right now, but the Fed started to tighten in 22. And we went from $18.2 trillion to $17.2 trillion in bank deposits. The entire capital market shut down. The banks all had to fire sale assets. Silicon Valley Bank failed. First Republic failed. That was $1 trillion of outflow, right? So if the Treasury is right and $2 trillion come out, or 6.6 trillion, they did a study that said that number. Something has to step in and fill that void. And I think this is the golden moment for DeFi. Mm-hmm. Right. And this is where, again, you're not sourcing new capital. You and I are taking our money out of the bank in the form of stablecoin, but then we have a medium to reapply that in a lending ecosystem where we can earn direct yield and disintermediate the bank as the allocator, right? We used to get zero as depositors or de minimis amounts as depositors, and the banks would charge normal market rates for that. Well, now we get a lot more lending directly.
It does feel, at least generally, the banks are extractive, maybe a little bit too aggressive of a word, but they definitely profit off of inefficiencies in the market, right? One of the things, I invested in this company, Bridget, years ago, that they identified the top 4 banks made like $8 billion off overdraft fees.
Right.
Like basically make money on people who don't have money in the bank, right? Lending is another one. There's all these, things that they do. As this technology becomes more popular and kind of finds its way into consumers' hands, do you think that it is actually a headwind and these banks are in a lot of trouble? Or is it something where like the pie grows and the banks will be just fine, but now you're just really expanding to, offer more services to more people?
No, I think the Genius Act is really the beginning of narrow banking, especially for regional and super regional banks. I think there's reasons why the money centers are going to be fine in terms of providing deposit relief. But I think it's going to be very hard for the regional and super regionals. And their position has been the government will never let this happen. And I think they misunderstand. I don't think that the regulators would let a financial calamity happen, but I don't think they have any affinity to keeping the banks alive. And so
disruption by innovation is different than lending contagion or something like that.
Yeah. I mean, the idea that you and I can take our money out of the bank and directly lend it and earn a better return is actually pretty consistent with the populist thesis of the current administration. So, it's not an orthogonal, a negative thing at all. And so, I think if I was the CEO of one of these banks, I would be having an existential moment right now about what does my business look like? Because I have potentially a physical footprint, right? I have brand value, I have franchise value, I have relationship value. But if I don't have that balance sheet, right, how does that transform my model? And that, again, is where I think the banks can lean in and start using DeFi. Mm-hmm. Now they can use DeFi, right? They couldn't 4 years ago or a year ago for the last 4 years. So I think we're at the precipice of some pretty significant change.
Talk about stablecoins. You guys launched a stablecoin that's pretty interesting, but obviously that has started to get a lot of attention just as an kind of a vertical within the industry.
Yeah, look, I mean, I think that, again, the biggest impediment that we've had is the ability to use it for payments. And I think with the legalization of coin through Genius Act, that will happen. I think the banks felt a little bit bamboozled about Genius in that they were very adamant that it not pay interest. It doesn't preclude someone like Coinbase, for example, paying you on your USDC deposits in the context of marketing rewards and so forth. I don't think they fully understood that going into it, and that might have changed their support for the bill.
Explain this a little bit more, because I don't think people quite understand. Like, basically, the banks did not want a stablecoin that replicated an interest-bearing account.
That's right.
For the most part, right?
That's right. They felt it was too competitive to their demand deposit account, and they didn't want that.
So I think the first point is, people see this Genius Act and they're like, oh, wow, this got done. It's like, crypto friendly, whatever. There was a battle behind the scenes between a lot of different players that was all jockeying for what was going to be in this bill, because it is a threat in some cases to these banks.
That's right. That's right. And whatever that battle was, the battle that's happening right now in Clarity, which is the Market Act, is 10x, right? Because in Clarity, you've got a really interesting construct where even within crypto, the centralized and decentralized actors don't have the same incentives, right, in terms of what they want for protection and legislation. In addition, you've got, the TradFi entities like the NYSE or NASDAQs of the world that, have their own views about how crypto should trade, right, and want to introduce that. So I think Clarity is going to be a harder process. I'm optimistic that it goes through. But whatever the knife fight was in the Genius Act, Clarity is like a knife fight in a phone booth.
So now we get, there is this ability for the Coinbase, the world, et cetera. They essentially found a workaround. Explain a little bit just like what these companies are doing where they qualify under the Genius Act, but it is something that maybe the banks didn't quite understand. Yeah.
So you're buying stablecoin and putting it on deposit at the broker, and the broker's paying you effectively interest, but in the context of a reward, right? And they would call it a marketing fee. And say, well, we would pay to acquire this customer. This is just a reward. We're monetizing back to them directly. But it's de facto interest. And so I don't think that the banks understood coming into this that this even existed. And I think they're now absolutely up in arms about it. But I think it's highly unlikely they're going to be able to amend the legislation to prevent that.
Is this something you would put in the category of like technologists being slick? Or is this something that the banks maybe just didn't do enough diligence, or a combination?
I think it was the latter. It had been going on well before the Genius Act had happened. So it wasn't that it was something that was slipped in. And I think, the reality is a lot of these banks should have had accounts at these crypto exchanges and understood how a lot of this worked. And unfortunately, most of them probably didn't.
Mm-hmm. Now, the stablecoin you guys launched, what is the differentiator? Like, what are you guys doing?
Sure. So we have a stablecoin called Yields. And what's different is Yields is a security. So it is not part of the Genius Act. It's actually regulated as a security. And the issue is generally with securities, you require some regulated entity to move it. So if I want to move it to you, it requires a broker dealer or a market exchange or an ATS, alternative trading system. And Yields is done as this relatively obscure security called a face amount certificate. It's the only type of security that's freely transferable peer-to-peer. So I can move $50 from me to you. Now, this introduced a lot of consternation with the SEC around, well, is that a KYC transaction or not? Because FinCEN is very clear that if a non-regulated, non-banking entity, non-financial entity is moving it, it has no obligation for KYC. So you can imagine all the consternation that we've had with the SEC on that front. But effectively, what we have with Yields is something we think you can do everything you can do with USDC, but it pays interest. Now, right now, what we're focused on is using it for our own loan market ecosystem, using it to settle our transactions, using it to represent remittance in the loans and so forth. We're starting to reach out and talk to exchanges about using it as collateral. So, perpetual collateral where you can earn interest on it. There's some interesting treasury use cases there. We will see how the payment infrastructure evolves. So Yields is backed by the same thing as stablecoin as it's treasury backed. So it has the same investment policy. So hopefully it won't be precluded from using the payment rails. And that's something, we're working with the industry on right now.
How much is the yield approximately?
I think right now it's SOFR minus 35, so around 4%.
Around 4%. So, I mean, it's pretty competitive given what people could do, outside of the crypto world or anywhere else.
Yeah, it is. It's intended to be effectively a freely transferable money market fund.
Got it. In those conversations, you started having the conversation with a different administration. You now have continued them with a new administration. Are there any surprising takeaways that you would say over the last 2 years or so with your kind of conversations with regulators that you think would be valuable for people to understand?
Yeah, look, I think the last 4 years have been probably the most difficult, prior to the change in the SEC specifically, the most difficult regulatory environment we could have being a blockchain company. I'm very proud of our team, what they've been able to build over that period. I mean, they built a business that, has originated $17 billion of assets, done over $50 billion of on-chain transactions, $339 million of revenue last year, profitable. But it was the most difficult environment you can imagine. And what we have now is the beginning of a better environment. The first step in that was the SEC not using enforcement as a policy tool. That allows us to think about things in the construct of rules as opposed to interpretation. And that's helped a lot. And the crypto task force, I think, has been very good in being receptive to the industry, being able to come down and talk through things. The Genius Act obviously is great to see that codification. What I'd really like to see in clarity is what Chairman Atkins is talking about in terms of protection for DeFi, and in particular, carving DeFi out from certain aspects of regulation. While that's his interpretation, and I appreciate that, I'd like to see it codified as law, because I would not like the next SEC commissioner to come in and not have that view.
What is that process like? Is that just like a regular legislation? And do you think that
it's going to be the Clarity Act? And like I said, that is going to be a contentious bill. We just got 180 pages of effectively a recast version of it out of the Republicans, and then we got 7 critical points that must be met out of some Democrats. In terms of how this is going to come together, and there's still a pretty and this is just across the two parties. And then, as I said, even within our industry, I don't think we're all aligned in terms of what we want out of this.
So it's funny because there's this framework I have where politicians historically very abrasive, very fragmented, very few people supported crypto in general, and there was a lot of very loud detractors. The industry was very aligned, very kind of cohesive in saying like, hey, Bitcoin, crypto, blockchain is good.
Right.
Fast forward to today, it actually in a weird way has swapped a little bit. Like politicians all understand we have to support this or like our constituents will vote us out.
Right.
but it's now like infighting in the industry that seems to be something that is much more abrasive than maybe it was in years past.
Well, I think in part it's because some of that regulatory quagmire was a huge benefit to certain incumbents in the space. And, the elimination of that changes the paradigm and introduces a competition that wasn't there before. And so, everyone has their own interests in terms of what they're advocating. I think there are some universal points that we agree on as an industry. Bitcoin's not a security, for example. But I think
that's actually the only thing that anyone agrees on.
That's why I said there's at least one North Star. That's it. But once you move off of that, people have their own interests, and like I'm a big proponent of decentralization, and everything we do, we use MPC for custody because we don't want to take possession or control of people's assets. Other people, that is their business model, to take possession and control. You've already heard me talk about, I'm not a fan of oracles and the representation of non-native digital assets on blockchain. Other people, that's their whole business model, right? Is to provide that medium of trust or representation. So, and I'm not saying I'm right and they're wrong or vice versa. It's just, we have particular views, and there are many in the industry that share our views, and there's some that don't.
We are seeing a lot of collaboration now. Obviously, Circle and Coinbase maybe is one of the biggest ones. We've now seen Tether make a lot of investments in various organizations. We've seen NASDAQ invest in Gemini. There just seems to be kind of, it's like everyone's got to pick a friend, right? And then like there's going to be this big competition. How do you think about the folks that you work with, or partnerships or allies that you all have going into what seems to be a very contentious battle for market share? Yeah,
one of the biggest challenges is the space is notoriously subscale. So, I think there's 2,700 crypto exchanges or something out there, of which 2,695 are probably subscale. And so, there's a tremendous opportunity for consolidation in a subscale market space. I think from our perspective, we've really adopted the idea of like, we are going to trust ourselves first. That's why, we originated the first loans on chain, even though now 170 third parties do that and represent way more of the market. I believe we will be the first native equity issuance on chain, right? And there's a whole series of things. I think we will be the first. And I like that because you don't have reliance on third parties. And doing mergers and acquisitions and roll-ups, there are people that are phenomenal at that. I've always struggled with it. Not to say we wouldn't do it, but it requires a lot of time, and a lot of energy, and a lot of focus. And that comes at the expense of all the other things that are out there. One of the biggest challenges that we all have is we're sort of the proverbial kids in the candy store, right? We went from a repressive regulatory regime to, hey, we want you to lean in and innovate, into what's potentially the biggest greenfield of innovation we've ever had. And so while I believe in the disruption construct, and I think blockchain will move more public market cap than any other technology ever has, and any other technology ever will, including the internet, the greenfield opportunities are even bigger. Right. And so you can get myopic in terms of, the idea of competition between big, blockchain native industries right now is kind of goofy, because the opportunity set is so enormous that, we shouldn't be worried about ourselves. We should be leaning in and trying to actually create new opportunity.
Where are those new opportunities?
Well, I think certainly in DeFi and its ability to step in if this deposit flight occurs and create a new kind of lending paradigm. That introduces a whole bunch of opportunity around, how do we deal with collateralization? How do we deal with liquidity? How do we deal with cross collateralization and correlation of assets? There's enormous things there. I think as the payment monopoly gets broken down, and in particular, we move away from these physical point of sale transaction devices into QR code, who are going to build those rails, right? And how are they going to work? And how does it extend into things like cross-border remit and treasury management and so forth? Huge opportunity there. And I think, when you think about the equity side, and what I always find interesting when I talk to people about this, people always gravitate to DTCC. They're like, all right, you're going to do a blockchain native public equity. You don't need DTCC anymore. no $50 billion of street capital, no GameStop issue, et cetera, et cetera. That's true, but go one level further to the exchange. Well, NASDAQ and ICE are centralized exchanges. What about a decentralized exchange, right? What about one where we can all attach our wallet to and trade, which means we don't need any introducing broker. So you don't need Robinhood or TD or Schwab. You go and attach your wallet and trade. But where are you going to get the margin? Where are you going to get stock loan? DeFi. Right. And so what you're ultimately talking about is a wholesale replacement of a capital system that's been in place for 100 years. And the value of that displacement is just enormous.
Today's episode is brought to you by Bitcoin OS. They're the ultimate upgrade to Bitcoin. Bitcoiners can now experience the magic of the entire crypto world, including DeFi, scalability, privacy, and more, without giving up control of their hard-earned sats. Powered by revolutionary zero-knowledge technology, Bitcoin OS lets other blockchains plug into Bitcoin, offering their services to the world's largest digital asset. This lets Bitcoin holders securely move their coins across the crypto landscape, turning Bitcoin into a productive, programmable asset. Putting your Bitcoin to work once meant trusting centralized companies and bridges to protect your assets, a model that's lost crypto owners billions to hacks and fraud. Bitcoin OS lets you be your own boss, using a system based on cryptography rather than trust, the way Satoshi intended. Using Bitcoin OS, altcoins are returning home, eager to plug into Bitcoin security, network effects, and $2 trillion capital base. Bitcoin is the first and final boss of all digital assets and will soon be reborn as the foundation of a united crypto world. Follow Bitcoin OS on Twitter at BTC_OS and be early to Bitcoin again. Follow Bitcoin OS on Twitter today at BTC_OS. Today's episode is brought to you by Polkadot. Polkadot offers secure, scalable, and decentralized blockchain technology that perfectly aligns with the needs of innovative projects. It was developed by Gavin Wood, one of the co-founders of Ethereum and the creator of Solidity. Polkadot aims to build an internet where users have full control over their data and their applications. Polkadot offers tons of unique features, a shared security model, along with the new auction model and significant implementations like ASIC banking. Given these characteristics, it's easy to understand why Polkadot is gaining more and more traction in the cryptocurrency world. Some people even are talking about it as the AWS of Web3. Now, companies such as Mythical Games, Astro Network, and over 50 other independent blockchains with hundreds of applications already leverage Polkadot's technology to power their platforms. If you're looking for a reliable, scalable, and cutting-edge solution, Polkadot seems to be the top choice for industry players. Go check them out today at polkadot.com. When you start to look at a lot of what's playing out here, I also think there's a difference between the East and the West. In crypto, we've seen Asia was very much not subject to US regulations. There was kind of a different culture, lots of capital pouring in there. The West, I think, has always said, hey, we have scale, we have rules, and we have what many people would look at as like the best financial institutions, et cetera. You're trying to build something that actually, I think the East is much more ready for, but you're doing it in the West and competing against these, kind of large institutions. Some people may look at that as a downside. I actually think in a weird way, it's like the classic innovator's dilemma where you're well positioned to disrupt some of these large players that aren't used to this.
Yeah. And look, I think the fundamental driver is it just works better for everyone who participates in that market, right? And that's, at the end of the day, that's why people lean in to use the technology. It took me...
It's like a true innovation that solves a problem.
Yeah. I mean, it took me years to convince Goldman to start using DART, which stands for Digital Asset Registry Technology, the way we register assets on chain, to use it for warehouse lending, right? So the way you do warehouse lending is I send the bank a spreadsheet full of loans. They send me a bunch of money, and then they spend 5 days figuring out if I lied to them or not, right? And this is a very high profile case that just affected JP Morgan and Fifth Third and a few other banks in terms of a warehouse borrower who double pledged the assets, right? Sent the same spreadsheet to two different banks and borrowed twice as much money intentionally, right? Defrauded them. And you can't do that on blockchain, right? And this is what I was trying to convey to Goldman. And also, I'm like, you don't need to spend the money to someone do the 5 days of diligence, but you can get me the money faster, and you've de-risked it, so you can give me more money.
So it's lower risk, cheaper and faster.
Cheaper and faster. So you can make more money and reduce your costs. And when they finally got to, and they're like, oh, public blockchain is scary. You're going to steal our loans, all this stuff. And I'm like, oh, you can't do any of this stuff. And there's an education. They're like, what if we lose our keys? That's like the most classic boogeyman of all in public blockchain is what if you lose your keys? And why MPC is so valuable. But
just tell David Solomon to hold them.
Yeah. But ultimately, we got them to do it. And they're like, this is great. Like, why didn't you tell us to do this years ago? This is wonderful. And, but this was in the prior regulatory regime. And I'm like, great, let's do a press release. They're like, absolutely not. You may not tell anyone that we are doing this. And as soon as the SEC changed and we were getting different Fed leadership, they called up and they're like, hey, we really want to do that press release now.
Interesting.
And because we're really like at the forefront of blockchain, and it's just
it went from being a risk to now it's cool to brag about being the leader.
That's right. They want to be seen, and I think all financial institutions are going to now want to lean in and be seen as being progressive within digital assets.
Is it fair to say that Figure in general, the big value proposition is you're essentially modernizing financial infrastructure? Is that like, if you really boil it down to like, what is the essence of this company? Yeah,
I think it's whether you call it modernization, whether you call it disintermediation, but again, not just disrupting what's there, really building what isn't. Mm-hmm. And I mean, look, we stood up the only liquid private credit marketplace that I've ever seen outside of Fannie Mae and Freddie Mac, and we couldn't have done that without blockchain.
Mm-hmm. Another area that you guys have pushed into is Bitcoin-backed loans. Again, kind of this like consumer lending, type DNA that you have. Describe like why that product.
So I love lending against Bitcoin, right? And
it's funny. Everyone who lends against it loves it for the pristine collateral that it provides.
100%. So I've been lending against people's properties since 2018, and generally we do a very good job at that. But there are loans we've lost money on. I've never lost money lending against Bitcoin. Mm-hmm. And what we're trying to do right now is a structure that I believe we can bring to market where if the borrower on a 12-month loan pays, something like a 1.5% fee up front, at a 50 LTV, we will immunize them from any liquidation, right? So we will never do a capital call on you.
And how do you do that?
We buy puts. Right.
Got it. So basically somebody can come and they can borrow against their Bitcoin. If they do not pay this one-time 1.5% fee, then there is liquidation risk, but they don't pay the fee. But if somebody pays a 1.5% fee, then you basically protect them from any sort of liquidation in the future.
That's right.
And it's a much, quote unquote, safer, I'll use my words, not yours, way to borrow against your Bitcoin, but it costs something.
That's right.
Yeah. And why does nobody else do this?
I don't know why people aren't doing this.
Yeah.
So.
I mean, it feels like this is the type of, to me, it's always like the market has said, hey, I want to borrow against my Bitcoin, right? You can see this across multiple companies. The trade-off is the liquidation risk. You're dealing with an 80 vol asset that, tends to go down when you don't want it to.
No, 100%. And a lot of people have a misperception about why people are borrowing against their Bitcoin. They think it's tax. Mm-hmm. It has nothing to do with tax. People just want to stay in the Bitcoin, mm-hmm. right? Because of that 80 volatility, it can double just as much as it can have, mm-hmm. right? Mm-hmm. And so they want to maintain that exposure. And so this gives them peace of mind of maintaining that exposure.
Yeah, it's pretty interesting that you then use the financial mechanism to protect them from themselves, essentially.
Right.
Yeah. Do you think you can get the 1.5% down even more? Or is that just the cost of the puts?
Cost of the puts, because the volatility is so high.
Yeah. And then that brings the question of like all these derivatives obviously have been very popular offshore. It does feel like maybe the US is trying to get to a place where we can start to bring some of this stuff onshore. Yeah.
I think one of the most interesting derivative innovations is going to be around the short-term lending index, being able to swap that to longer rates. So if you look at, a platform like Democratized Prime, where it's hourly, or Aave, where it's continuous, generally, DeFi is not a term borrow structure. It's not a term borrow structure because, once you introduce term, you don't have homogeneity of those loans. Today's loan isn't the same as tomorrow's. And so the problem is people do want term. They want to hedge that out from an asset liability standpoint. So I think there's an interesting opportunity to create a swap market. The issue is, who is the logical other side of that swap? And that's one of the things I'm spending a lot of time thinking about right now in terms of trying to build that out and bring it to market.
When you look at the future of the business, do you just go product by product on Wall Street and try to pick off like the lowest hanging fruit and say, look, where are the areas where there's really big spreads, there's a lot of inefficiency, and this new technology can solve that problem? And that's what determines?
What we do is I've got a great synergistic relationship with Mike Tannenbaum, who I brought in as CEO to run. last year I split Figure into two because I was trying to take Figure public and the regulatory regime was just too difficult. And I took all the crypto and blockchain heavy stuff in markets that I went to run. And I bought Mike in, who I'd worked with for a long time ago at SoFi. He was the chief revenue officer there. And more recently, he was the CEO at Brex. I brought him in to be the CEO. And when the regulatory environment changed and the public market changed, it made sense to recombine the business. I asked him to stay on as CEO. And part of why I did that is it gives me the ability and flexibility to really focus on all the 0 to 1s. Mm-hmm. And so I've got, 5, 6, 7, 8 different things that I'm looking at any single point in time. And when they come to fruition and hit that one, I can push them up to him at the organizational level and he can scale it to 100, mm-hmm. right? Mm-hmm. And so that's kind of how we look at it. So on any given point in time, there's no shortage, not just, as I said, of disruptive opportunities, but greenfield opportunities that technology affords. And I'm fortunate to have a partner that can then take those ideas when they show merit and really turn them into businesses.
You've been innovating in financial markets for a very long time. You've built now numerous multi-billion-dollar companies. Do you have any advice for either people in the crypto world or people in the traditional world that are trying to also kind of blaze their own trail and innovate?
Yeah, my two pieces of advice, and one we were talking about very recently. The first one I always tell everybody is, don't be, you need to be obstinate enough that when people tell you you can't do something, you're not listening to them, right? You can't be crazy in the sense of I'm going to turn lead to gold. There's some things. I used to say flying cars, but I'm not sure that's that crazy anymore. So you have to kind of thread that needle, but the first part's more important than the latter. But the second is when you're pitching your idea, do not use someone else's company. Do not be, I'm going to be the Uber of this, right? Or the SoFi of this, or the Figure of that. Like, be yourself in terms of how you're talking and describing what you're doing. Like, be category defining. Don't take someone else's category and try to fit into it. One
thing that I've observed, we've worked together now for quite a while. I'm an investor in Figure for a number of years. You're a very good fundraiser. Very good. What do you think are some of the lessons you've learned there on that front as to you can be a good fundraiser, and if you don't deliver returns, then you become a very bad fundraiser because no one wants to give you money anymore. You've been able to obviously deliver returns, but there is something about the fundraising process that you run that is effective.
Yeah, look, it's you want to build on making people money, and the more money you make people, the more likely they are to be receptive to you coming back and talking about your next ideas. And one of the things that was personally rewarding to me when I was out on this IPO roadshow was I had more than one investor say, Cagney, your ratio of say to do is the highest we've ever seen in an entrepreneur. And, that meant a lot to me, just in terms of executing to what it is we're trying to do.
Mm-hmm. And then lastly, for those that are looking at the business, trying to understand it, what's kind of your pitch as to what Figure looks like moving forward and maybe even the type of shareholders that you're looking for, given that as a public company, there's plenty of people who want to trade in and out of these things, but you want kind of, alignment with those shareholders.
Yeah. We really want people who are aligned with the idea of revolutionizing capital markets, right? And I think what Figure is going to do is change market structure, both existing markets that we know of. I gave the stock market as an example, but also new markets that we didn't have. Your ability to lend against Figure assets, for example, or other loans, non-Figure loans. And so, to me, this democratization, which is really at the core of what DeFi is, which, there is no delineation between you and I or the biggest investment bank in the world. And DeFi, it's all the same dollars going against all the same assets. That's really what unlocks a huge amount of opportunity. And so we like people that are aligned to that and want to participate in that ecosystem.
Where can we send people to find you on the internet? I know you don't create a lot of content on the internet, but when you do, it's very high quality. So where should we send them?
Figure.com obviously is our site. And then I'm on Twitter, I'm Cagney, and I'm on Telegram, I'm Cagney.
LinkedIn though?
I am on LinkedIn. I don't use it as much.
No, you post on there every once in a while.
I do. It's not.
Mike, you're supposed to say, I got the best LinkedIn. Go follow me on LinkedIn.
I have a great LinkedIn. Please follow me on LinkedIn. Very important to do that. I'm also M Cagney there too. See, I'm the first on all these platforms, which is why it's M Cagney on everything. I'm M Cagney at Gmail. Yeah. Right. But LinkedIn still is great for lots of purposes. So I didn't mean to poo-poo it.
No, but you do tweet often, and I think I've been doing a great job there as well. So I appreciate you taking the time to do this. We'll do it again in the future.
All right, thank you.